When a company issues a bond, they are drafting a rigid, legally binding contract to pay a fixed amount of money in the future. But that fixed contract is immediately thrown into an unpredictable market, forced to bend to external economic pressures. Because of these shifting pressures, the price investors are actually willing to pay on issuance day almost never matches the face value printed on the physical document. Instead, the issuance price is strictly dictated by the present value of the bond's future cash flows. We can break these cash flows down into two specific components: the massive lump sum of the principal due at maturity and the ongoing annuity of periodic interest payments. To find their worth today, we pull both of these future flows back to year zero. The critical detail here is the discount rate used to pull those flows back. We don't use the stated rate printed on the bond. We use the prevailing market interest rate exactly on the date the bond is sold. Since market rates fluctuate daily while the bond's stated rate is locked in ink, a mathematical discrepancy is born. The actual cash proceeds received from investors will almost always be slightly higher or slightly lower than the bond's true face amount. This mismatch creates one of two outcomes. If the market demands a higher return than the bond offers, the bond must be sold at a discount. If the bond offers more than the market demands, it commands a premium. To reconcile this upfront discrepancy over the lifespan of the bond, accounting standards require the use of the effective interest method. This method relies on a strict statutory formula. The company's annual interest expense is calculated by multiplying the bond's beginning carrying amount by the effective market interest rate from the day it was sold. Notice the built-in tension here. The effective interest rate is a historical constant, permanently locked in on the sale date. But the carrying amount is a moving target that shifts every single year. This forces the reported annual interest expense to act as a dynamic variable. The balance sheet uses this changing value to systematically correct the initial pricing mismatch, aligning the reported expense with the true market cost of the debt. Let's look at this table to see the math in action for a bond issued at a premium. The company issued a $1 million bond, but because the stated rate was attractive, investors paid over $1,083,000 to acquire it. To calculate year one under the effective interest method, we isolate our starting variables. The actual cash received sets our beginning carrying amount, and the historical market rate is 6%. Multiplying those two figures gives us the true economic cost of the debt for the first year, an interest expense of exactly $65,038. Now compare that calculated expense to the actual cash leaving the company's bank account. Based on the rigid terms of the bond contract, they must pay investors a flat $80,000. Taking the difference between the $80,000 in cash paid and the $65,000 true expense leaves us with $14,962. This difference is the premium amortized. It acts as a mechanical correction factor. Since the investors overpaid up front, this $14,000 is effectively returning a portion of their original principal. That $14,000 gets subtracted directly from the carrying amount on the balance sheet, dropping our ending value to roughly $1,068,000. When we roll the calendar forward, that lower balance becomes the starting point for year two. Applying our static 6% rate to this smaller base yields a direct mathematical consequence. The year two interest expense drops to $64,140. The math establishes a definitive rule for premium bonds. Because the principal is constantly being paid down, the carrying amount must decrease toward par value. This shrinking base forces the reported interest expense to decrease every single year. Now, let's look at the second table, where the market scenario is inverted. Here, the market rate was 10%, so the $1 million bond had to be sold at a discount, bringing in only $924,280. We start our year one calculation with these new market conditions, a lower initial carrying amount and a higher effective rate of 10%. Multiplying them together reveals a true year one interest expense of $92,428. Notice the inversion. The true economic expense of $92,000 is now significantly higher than the physical $80,000 of cash being paid to investors. To account for an expense that exceeds the cash paid, the accounting system takes the $12,000 difference and adds it directly to the bond's balance. This pushes the ending carrying amount up to $936,000. Rolling forward to year two, that larger starting balance is multiplied by our 10% rate, resulting in a higher year two interest expense of $93,671. This proves the inverse rule.
Because the company received less cash up front, the discount amortization constantly increases the carrying amount toward par value. In turn, that growing base mathematically forces the interest expense to rise with each passing year. Let's apply this mechanics-first approach against a standard conceptual exam question. The question asks us to identify the relationship of interest expense over time for a bond recorded at a discount using the effective interest method. A discount means the bond was sold below face value, so its carrying amount must systematically grow upward over its lifespan to reach par. Since the annual interest expense is simply that ever-growing carrying amount multiplied by a static market rate, the expense itself must also grow. The math dictates that for a discount bond, the reported interest expense will increase every year. The effective interest method functions as a self-contained logic gate. Once the initial variables are set, the year-to-year trajectory of the expense is a mathematical inevitability. Stepping back from the annual tables reveals the elegance of the entire bond lifecycle. Whether a bond is issued at a discount, climbing upward, or a premium, sliding downward, the engine is the same. Both trajectories are mathematically tethered. As amortization adjusts the balance sheet, true expense is pulled toward the fixed cash payout. The effective interest method is an automatic, self-correcting system. It ensures the income statement reflects true economic cost, perfectly aligning the balance sheet with reality by the exact day the bond matures.